Hello and welcome to the Trading Bell. And today we focus on the banking sector. The full year results for the year 2022 are coming out and different banks are performing differently. Today our focus will be on Stanbic Bank. And I'm joined by Dennis Musau, who's the Chief Financial and Value Officer at Stanbic Bank. Dennis, welcome to the Trading Bell.
Thank you.
Quite a strong performance for the year 2022. I can see profit after tax 26% up. The year was indeed that recovery year from my assessment, wasn't it?
Yeah, and thank you again for having me on the set to speak about our financials. The year 2022, coming off 2021 and of course 2020, was a year for us to, and for our customers to really get back to normalcy, if you like, to start beating the cocktails of COVID, to try and get back into business, whether the traditional businesses they were doing or different businesses or varied businesses. Yeah, so that is the space in which we operated, not without challenges, probably slightly different challenges. We saw, you know, whether you talk about North America, whether you talk about the Eurozone, whether you talk about Russia, Ukraine, whether you talk about the Chinese policy on COVID, and you bring that all back home. You talk about drought, you talk about inflation. So it was a different set of challenges, but when you are in a sector such as ours, our job is not to be afraid. Our job is to kind of deal with those challenges and help our customers and our investors to get past those challenges.
Definitely. And I'm glad you've mentioned all the storms. They call them the perfect storms, especially in Kenya.
Yeah.
They are really aligned. Globally, we are seeing supply chain constraint matters, Ukraine, Russia. At the same time, we're seeing China with their response to COVID, as you've mentioned. And locally, we don't have rains. Inflation is skyrocketing, quite concerns here and there. And looking at that, and you guys posting, you know, profit after tax of 9.1 billion shillings. What are the major drivers of this?
So we have a purpose, and that purpose actually, Stanbic Bank is a member of Standard Bank Group, which is the biggest banking group across Africa, operating in 20 countries. And we say our purpose is Africa is our home, and we drive our growth, and therefore Africa's growth, Kenya's growth, South Sudan's growth is our business. And that is the purpose we continued to execute on. Now, when you look at the 9.1 billion, it looks, you know, and it depends on what lens you look at. But there is a lot of work that has gone into that. We grew our lending to customers to support their growth by 27% year on year. We grew customer deposits by 12% year on year. We grew our balance sheet 22% year on year. We worked very hard to make customer onboarding digital, to make digital, to avail digital lending. We recently launched a Chama app, and we are very proud of, you know, I was looking at some statistics, and there are more than 300,000 chamas in Kenya. You know, to be able to avail such a platform to the market. We launched an SBGS app, which allows you and I, coincidentally we are at the NSC, but we didn't have to come here to trade shares. We could have done this. So we've invested in transforming that client experience. The second part of that has been investing in efficiencies. And you will see that in our cost-to-income ratio. Our cost-to-income ratio 4 years ago was in the mid-50s. Proud to say that we are now at 46.7%. And that is blood and sweat, trying to ensure that we extract efficiencies in our operations, trying to ensure that we invest in operational, in processes that allow us to turn services to the customers much faster and more efficiently and in a cost-efficient way. And then the last one is sustainability. Okay. And the return in itself, when you look at profits and we come and say we announced this number versus the other number, we take more pride in the effect and the impact of that. We participated, if I can just pick one example, in this expressway, which has reduced the time that we take to go to Mlolongo and back by 80% or 90%, depending on the time of day. Now, we are proud of those things alongside the return and the profits that we're able to print.
All right. On the lending bit, you say lending has grown. First of all, talk to me about the sectors that you're lending towards. I know we've had a change in government and there are specific agendas like the previous government talking about the Big Four agenda. This government is bottom up, so lending to SMEs and individuals. This growth in lending, where was it directed to?
We can't grow we can't live our purpose outside of what the government is doing and the areas it's focusing on. Our lending grew in manufacturing. We grew our lending in power infrastructure. We grew our lending in oil and gas. We grew our lending and our offerings in the tea sector and agriculture sector, which is 20-something% of this market's GDP. We are quite aligned with what the government is doing and the things that the government deems important for this market are important to us. And that is why our purpose has to go back to driving Kenya's and South Sudan's growth.
All right. Yeah. And talking about asset quality, in terms of NPLs, so far, how do the ratios sit?
9.1%. NPL ratio. Last year, 9.25. The year before, 11. So we've worked very hard to manage our credit quality, and it's two pieces. One is managing our customers who have struggled, and then the second one is really writing good book. I should say that the market NPL ratio is in the region of 14%. So we feel 9% is kind of the right area. We'd like to kind of reduce it much further, but we're also careful not to cut it to a point where we don't have any risk appetite. There's got to be a balance. But being below market by about 5% for us is a mark of strength in our lending capability, especially when you compare that to a 27% loan growth.
Yeah. I know, and because we've seen, especially the year 2022, of course, was poised to be that year of recovery, looking at different sectors. During COVID, I know hospitality was hit very hard, and if you're directing credit towards that sector, you had to, rethink about that. Yeah. In terms of this reduction, which sectors are showing improvement in terms of, on their value of their loan and also sort of being able to fulfill their obligation?
Kenyans and Kenyan people and businesses are very resilient and very dynamic. What we saw post-COVID was that, businesses tried to kind of remodel themselves. We had people who were selling books starting to sell sanitizers. We had people start to sell masks, things that we didn't actually, kind of know that existed outside of hospitals. So we haven't seen a massive shrinkage. There has been kind of challenges in tourism because of lockdowns and all that, and economic hardships. There has been challenges in hospitality because of obviously tourism and other factors. But what we've seen with our customers, and which is why then the NPL ratio still continues to be managed downwards, is they have remodeled their businesses to turn with the times. We're seeing more players than we ever saw in digital kind of offerings. Whether you talk about e-commerce, whether you talk about just any form of, digital lending has become very, very well intermediated. Payments, there's a lot of people getting into payments. So we've seen businesses remodel and vary themselves, and not sit and just say, oh, I used to do this, it's now gone, and therefore that's the end of me.
Definitely.
Yeah.
That's very important to note.
Yeah.
So I'm looking at your deposits. It's a show of confidence. I can trust you with my money. And that aspect is also growing, especially amidst sort of an economic downturn. How do you balance the two, increasing deposits? How do you convince people to deposit money with you more?
Noah, we were voted, I can't remember now, but not too long ago, as the most trusted bank in this market, Stanbic Bank. And increasing deposits at a rate that is faster than the market. Just for context, when I look at 9 months, the local banking sector reported a 7% growth in deposits and a 15% growth in loans. Deposits have definitely been hard to come by, right? Especially when you think about where yields are. If you're chasing yield, then you can go elsewhere and get some yield. When you look at the US interest rates, risen by more than 400 bips in the last 1 year. If you're holding hard currency, there are options out there. But because we are a trusted institution, both for safety but also for transactional flows, our customers keep coming back. And you will see we pay for it. Our interest expense went up 15%. Interest income obviously went up much faster, which is why we're able to record a 33% increase in NII. But our customers are trusting that their money is safe with us, and they're trusting that where we're deploying this money is in the right areas, because we've told them our purpose in this market is very clear. We're going to be part of telling the Kenyan growth story.
Part of that telling of the Kenyan story for the longest time, especially where banks put their money, the nature of investments that you do. Are we still seeing heavy, channeling of resources towards government infrastructure bonds, which are kind of safe to play, very secure, and becoming more risk averse? Or as we move away from the COVID, the 2020 situation, the risk averseness is sort of coming down?
Look, there is very little fulfilling of our purpose in giving our money to, keeping our money in infrastructure, bonds and other instruments. We take pride in deploying as much of our liquidity as we can to customer franchises, right? Now, it is so happens that sometimes that we will have excess liquidity. And you will notice, for example, our government securities holding went up 40% year on year. It's a snapshot view, but it's really short-term instruments as we await deployment into customer deposits. Now, if I look at interest income, our interest income on loans increased by 28%. Our interest income on government securities increased by 12%. So we are more intentional about deploying instruments into customer franchises. If there's an opportunity and where we have excess liquidity and we are waiting to fulfill customer demand as the profiles come through, then we'll put that money in the overnight market or in government securities on short term.
All right, definitely.
Yeah.
Now, one of the critical bits that we've seen in the market has been the removal of interest cap, which majority of banks, if not all of them, were really pushing. The caps which were introduced in 2019 to sort of help as buffer. And we've seen now we are back to risk-based lending. Quite a change in terms of the rates that we are getting loans. Some of them are being readjusted. How, in Stanbic, how much of swing are we seeing? Are we seeing huge jumps on interest when you come to risk-based pricing as compared to especially loans that are taken under the cap regime?
So the one challenge in principle that you have when you have an interest rate cap is that it naturally excludes certain parts of the population from the credit market. Because, and what risk-based pricing, in my mind, tries to solve is two broad principles. The first is transparency in pricing. So customers in the past said, you told me my interest rate is 12%, but I see another fee here, I see something else there. Just tell me everything. And customers are not afraid of the truth. If you say to them, actually your total cost of borrowing is 15 or 20 or whatever the number is, then they can go through that math and see whether the return on where they want to spend this money is better than what they're paying for it. So risk-based pricing allows for that all-inclusive pricing for the products that you're giving to the customer.
Yes.
The second broad strand here is risk-based pricing then allows customers to determine their cost of credit. And I think this is kind of the biggest benefit you get when you avail the formula to the market, which really is as simple as this is the amount at which I get the money that I'm lending to you, plus my operational costs, plus XYZ, plus your risk premium. Then you get a price.
All right. So essentially you're saying sort of making it open and controlled, it allows more people to participate. And unlike initially, because the argument has always been, if we cap it at this, then it is more accommodative, but also you become more selective in regards to the person that you're giving the loans to.
And that cuts availability of credit to the market, because unfortunately, if you, whatever number you choose, even if you said your limit is 30%,
yes,
right? Ridiculous, but assuming that was possible, there are still people who are outside that band. Remember, there are people who borrow with the sole intention of never paying. And you have to go through extreme difficulty to recover the money that you lend to those people. So by opening up this thing, and for me, the principle of transparency and how the thing is computed and having real conversations about why is my risk premium 2% yet NOAA's is 1%, what do I need to do? For me, that is the greatest empowerment that banks can do to the market. Now, what that does is, as private sector credit growth grows, then you improve on employment. You start driving the economy towards growth.
Definitely.
Yeah.
Of the 9.1 billion shillings that you've made in profit after tax, how much are we giving to the shareholders?
55%. 4.98 billion shillings will go to our shareholders. That is a 40% increase in our year-on-year dividend payout. Last year we paid 9 shillings to the share. This year we are paying 12.6, subject to the shareholders' approval when we meet in May. And this is really just an appreciation that, in banking you interact with a lot of stakeholders. You have your staff that you compensate for their work. You have the government that you work together and you pay taxes. You have customers that you serve to the best of your ability. You have communities that we continue to serve as much as we can. And then you have shareholders, the investors. And this is our way of appreciating these shareholders. By the way, our shareholders don't just get the dividend. Our share price on 4th or 3rd of January 2022 was 87 shillings. Today on this screen, I've seen that number is 109 shillings. So they don't just get this 12 shillings, they're also getting close to 20 shillings or more than 20 shillings in share appreciation. And that for us is real value creation for our shareholders.
Definitely. Yeah. Briefly as we finish up, 2023 is quite young. Talk to me about the prospects. I'm seeing a lot happening, especially in SME lending. Now the government is entering to the second phase of Hustler Fund, lending to groups between 50,000 and, is it 2 million shillings? Where is Stanbic in this conversation, and what will shape, what is shaping your 2023?
So 2023 is our year 3 or season 3 of our strategy that we are on. We will be reflecting on our strategy for 2024 to 2026 in the coming months. We are going to stay true to the strategy that we've set out. And that strategy speaks to transforming our clients' experience, operating efficiently and sustainable returns. On the transformation of client experience, the work that we've done on digitization is going to continue. We will come to the market with more innovative solutions. We will partner with government. We are not in competition with government. We will partner with government to drive things that matter in this market, and things that really drive growth for our customers. I just talked about Chama app. I talk about the SBGS app. We have a mobile banking app that allows us to interact with our customers. We have digital customer onboarding. We have digital lending. We are adding more variants into digital lending. We are digitizing our VAF. We are digitizing, to a certain extent, home loans. So we are going to continue on that journey. We've just enhanced our T billboard that manages the auction in Mombasa, where more than 80% of the traffic goes through. We've added working capital facilities in there. So we're going to continue along that grain. On internal, on operational efficiency, we are going to continue working on digitizing our internal operations, using data, using robots to manage risk, using data-driven risk management processes, using robots to do reconciliations. So we're going to invest a lot more in extracting efficiency. We're going to grow our people. We've been deliberate about investing in our people, in future-ready skills to be able to do different things for our customers going forward. And then we're going to continue serving our communities. If you allow me to just give stories that really excite me. We went into a partnership. We don't just do CSR at Stanbic. We went into a partnership between Stanbic Bank, Java, who is one of our corporate customers, and the Rotary Club of Nairobi Samawati, which is a Rotary Club of Stanbic bankers. And we identified a school around Kawangware called Gatina Primary. And we feed that school, or we provide a feeding program for that school. We physically actually go there on Fridays to go and feed the children, especially the Rotary Club. And for us, what is exciting is to see that school, when we started this program sometimes last year, had 1,200 kids coming to school. We now have 1,600.
Oh.
Now, so for us, that is impact. And if we had time, there's many more impactful stories of people we have partnered with either through the bank or the foundation. We have a story about some company in Nakuru which we gave a grant to, I think $50,000, had 4 employees or something like that. When we last checked, it had 39 employees. That for us is the impact that we are going to continue driving. So our strategy remains. Yes. We are going to be executing on season 3 of that strategy, okay, and driving Kenya's and South Sudan's growth.
Oh, thank you very much.
Asante.
Dennis Musau, Chief Financial and Value Officer at Stanbic Bank, saying that the key issue is sticking and remaining true to the strategy to make sure that they're impacting society and also, based on the results, making money for their shareholders. Well, with that said, I'll leave it.